Hi guys, how are you doing today? We are doing great. Welcome back to my channel. This is Phenomenal Pips. So this is the second part of a technical analysis that explain how to trade pattern, candle formation, flags, channel, and others. So if you are new on this channel, please kindly click on subscription button, click on the bell, so that anytime I upload a new video, you'll be able to see it. Stay tuned.
The flag pattern, usually taking place over few weeks or months. It follow this guideline. First, identify a strong trend, flagpole. Second, through the duration of this uptrend, eventually prices need to rest, and consolidate those gains. This price consolidation becomes the flag of the pattern. The flag of the pattern tends to be a gently downward sloping price channel for a bull flag, and the opposite for a bear flag. Additionally, this consolidation will retrace a small portion of the previous uptrend. If the retracement become more than 50%, it may not be a flag pattern. Ideally, we'll see the retracement be less than 38%. Since this is a continuation pattern, we look for prices to break higher, with a length equal to the size of the flagpole. An example of a flag pattern, on a weekly chart. Our consolidation period never breached the 38%. In this example, again, the textbook entry, and mine based on confluences. Like 38% Fibonacci level, combined with trend line. Enough for a try, but with a pattern on top of it. We can see the difference in risk between the two entries. Reversal pattern. Most interesting chart pattern are reversal pattern. In the following part, we will see different pattern, by complexity. From the easiest one, double top, bottom, to the more complex one, like Gartley pattern. The double top, and double bottom are very common reversal chart patterns. The double top is a bearish pattern that occurs after an uptrend, while the double bottom is a bullish pattern that occurs after a downtrend. This means that when you see the pattern, you will then look for selling or buying opportunities. There are two highs formed, where the price has attempted to break through a resistance level twice before reversing to the downside. There is also what we call a neckline, which is considered the bottom part of the pattern. What is happening is that the buyers have attempted to push the price through a key level like here, but were unable to due to the sellers entering the market. There was a second attempt by the buyers, but they were unable to break through to new highs, because the sellers entered the market in force once again, and overpowered the buyers. Once it became apparent that the buyers were unable to push the price through the key level, the price then reversed to the downside, with more sellers entering the market. The price must break the neckline of the pattern, in order for it to be a valid double top pattern. However, you will usually find that I would enter the market on key level, and if pattern confirmed, I would only stay longer in the short. Unlike most trader that trade pattern, I do not pattern trade, but rather use the pattern in itself, to either increase target profit area, or get out of a position. It is unlikely that I will enter a trade only based on a pattern. Here an example of a double top pattern. This pattern on its own would be a good trade. But if you look at it now the way I would trade it, let's say for example, my key level was a potential short, second try is often a good one. Now being short, I would have a preset target, but if a double top was confirming itself on my short, first I would extend my target, second, I could look at adding a short position on the break of the neckline. This would yield a much better reward, and at a lower risk. Indeed, if that pattern failed, and my added position was on neckline, it would be covered by my previous short. And I would not wait to touch key level again, to close trade. The head and shoulders pattern is generally regarded as a reversal pattern, and it is most often seen in uptrends. After a long bullish trends, the price rises to a peak, and subsequently declines to form a through. The market begins to slow down, and the forces of supply and demand are generally considered in balance. Sellers come in at the highs, left shoulder, and the downside is probed, beginning neckline. The price rises again, to form a second high substantially above the initial peak, and declines again. Buyers soon return to the market, and ultimately push through to new highs, head. However, the new highs are quickly turned back, and the downside is tested again, continuing neckline. The price rises a third time, but only to the level of the first peak, before declining once more. Tentative buying re-emerges, and the market rallies once more, but fails to take out the previous high. This last top is considered the right shoulder. Buying drop and the market tests the downside yet again. Your trend line, for this pattern, should be drawn from the beginning neckline, to the continuing neckline. Volume has a great importance in this pattern. Volume generally follows the price higher on the left shoulder. However, the head is formed on diminished volume, indicating the buyers aren't as aggressive as they once were. And on the last rallying, the right shoulder volume is even lighter than on the head, signaling that the buyers may have exhausted themselves. New selling comes in, and previous buyers get out. The pattern is 8, when the market breaks the neckline. Volume should increase on the breakout. Head and shoulders, always come from prior trend. The volume on the first shoulder is often greater than the head, showing sign of a potential rejection, and seller's strength. The last shoulder, should always have great volume on the break. A brilliant tool, is the ADX, to confirm a potential break. Typical entry is on the neckline break, mine differs, as I would always try to enter, here, on top of the right shoulders. In this live market condition example, we can identify, first, this head and shoulders. This was a trade given on social media. This trade was great for the reasons explained before. First, it had this particularity, of being a head and shoulders, in a head and shoulders. And second, because my entry was based on trend line, on the hope of having a head and shoulders confirmation, which I had few days later. But what made it special, is that I did add a position on this specific trend line, on the wake of a possible new head and shoulders. This once again, shows you the power of trend line. This extra move alone was 150 pips. The reversal wedge. The reversal wedge is identified by the followings. Prior trend. To qualify as a reversal pattern, there must be a prior trend to reverse. Ideally, the falling wedge will form after an extended downtrend, and mark the final low. The pattern usually forms over a 3 to 6 month period, and the preceding downtrend should be at least 3 months old. Upper resistance line. It takes at least 2 reaction highs, to form the upper resistance line, ideally 3. Each reaction high should be lower than the previous highs. Lower support line, at least 2 reaction lows are required to form the lower support line. Each reaction low should be lower than the previous lows. Contraction, the upper resistance line, and lower support line converge to form a cone as the pattern matures. The reaction lows still penetrate the previous lows, but this penetration becomes shallower. Shallower lows indicate a decrease in selling pressure, and create a lower support line with less negative slope than the upper resistance line. Resistance break, bullish confirmation of the pattern does not come until the resistance line is broken in clear way. It is sometimes prudent to wait for a break above the previous reaction high for further confirmation. Once resistance is broken, there can sometimes be a correction to test the newfound support level. Volume, while volume is not particularly important on rising wedge, it is an essential ingredient to confirm a falling wedge breakout. Without an expansion of volume, the breakout will lack conviction and be vulnerable to failure. The ABCD pattern. There is 2 possible ABCD, the bullish, and the bearish version. ABCD pattern is one of the greatest pattern, and probably one of the most used one. It is very specific, and that makes it one of the pattern traders' favorite. How to spot and trade an ABCD system. The first thing is to master the Fibonacci retracement. Indeed, the first part of this trade require you to identify a move, from A to B that can be retraced via Fibonacci. Once a move like this has been established, see how to use Fibonacci retracement in Part 3a. We will be interested in our second most significant key level, Fib level 61%. Once the Fibonacci has been drawn, and that our price has retraced back to 61%, we will start thinking ABCD system. What that means is, if the price reaches 61%, we can call it C. Now if price bounce back from C, there is 2 absolute rules that must be respected in order to make a valid ABCD system. Those rules are the ones that make this pattern so special. Rule number 1. The time it took to go from A to B, must be the same to go from C to D. Second, the price level for D, must be at an extension of 127% of AB. That means, using a Fib retracement, and selecting extension level 127%, D must meet this price level, at the exact time it took to go from A to B, to go from C to D. In our chart this gives us the following. So if like in this chart D, is met using the following, then the trader, can expect a very strong reversal, to at least C. This is a summary of all the conditions required to obtain a valid ABCD pattern. Unlike any other pattern that require confirmation, the advantage of this one is that you can set a pending order in advance at the exact price with an accurate time validity. This is easily made using Trader platform. This is an example of ABCD system. However, in this example price did not reach C, but was still a good trade with good risk reward. While ABCD is great pattern, there is one thing I like to do, that ABCD pattern trader probably don't. It is to trade ABC before D. What that means is, I will not always wait for D before to place a trade. If you know where D is, and you know where it has to be reached to have a valid ABCD, why wait? After all, where is the risk in trying the second strongest key level, if there is good reason to trade it? The advantage of this method is, first you know exactly when and where target should be reached. Meaning if it doesn't, you know you will not complete an ABCD, and therefore can take profit before. If you do, you will profit twice more once you reach completion of the overall pattern. Laid down here are the conditions on how to trade the ABC before D. Moving now on to complex pattern, like the 3-drive pattern, bullish or bearish. The bullish 3-drive pattern suggests market potentially at its most bearish, or higher probability for market reversal. Typically offers excellent risk-reward ratio. Pattern failure suggests potentially strong bearish continuation move may be in progress. So even failure is useful. The 3-drives pattern is characterized by a series of higher highs, or lower lows that complete at a 127%, or 161.8% Fibonacci extension. The bullish version of the pattern can help to identify possible buy opportunities, and the bearish version can help to identify possible sell opportunities. As you can see above, the price makes an initial low at point 1, this is the first drive of the pattern. Price then retraces before making a new low at point 2, forming the second drive. This second low should be a 127%, or 161.8% Fibonacci extension of the first drive. The price then retraces once again, and makes a third drive down which should also be a 127%, or 161.8% Fibonacci extension of drive 2. It is this third drive that you want to pay the most attention to, as this is where you are looking for a long entry. You look to enter the market on the third drive, as this offers the most precise entry point, with the greatest profit potential. This will either be a 127%, or 161.8% Fibonacci extension. For a bearish 3-drives pattern, a short sell trade, simply invert the pattern, and your orders. A simple way of finding a profit target is by drawing a Fibonacci retracement from the very high of the start of the pattern, to the very low of the pattern, where the pattern completes the third drive. The take profit is the 61.8% Fibonacci level of this swing. The stop loss would be placed just below the 161.8% Fibonacci extension level of drive 2. The diamond pattern, which is a combination of two smaller pattern, a triangle formation, and an inverted triangle formation. Diamond pattern, the diamond pattern, since technical traders use this pattern to predict a reversal of an uptrend, a short position is taken when the price falls below the lower ascending trend line. In general, price targets are usually set to be equal to the entry price, minus the distance between the top and the bottom of the pattern.